Alright, so one of the favorite series that I do on the channel is the subscriber portfolio reviews that I do of all my subscribers that send me their portfolios transparently. My subscribers actually have the guts, unlike many other finance YouTubers, to transparently share their portfolio for the entire world to see. So today, I'll be going over the CyberStoics portfolio that he sent to me over on the Discord, and of course, if you want me to go over your portfolio, go over the Discord, send it to me there. Also, if you're not aware yet, there are two Black Friday/holiday deals going on right now. One is for DividendData.com, which is the investing software I use. 30% off for the first 30 customers. Go check that out. Use my link in the description. It really helps out the channel. And also the Do Dividend Stocks Not Drugs merchandise is having a 15% off sale through Christmas. So it's an amazing gift for any investor in the family. We also just added a new coffee mug, so if you're into that, go check one out, go buy one, let me know, send a picture of it when you come in and I'll feature in a video. And of course, roll the Christmas intro.
Here comes Santa Claus, here comes Santa Claus, right down Santa Claus.
Please, it's too much winning.
Reindeers pulling on.
Hello, I like money.
Alright, before I actually get into the portfolio, I'd like to know the goals of the portfolio itself. I think it's inappropriate and just not fair to blindly judge a portfolio without knowing the goals and objectives and all that. So he said that his goal is to buy quality companies that are in their cash flow generating phase in their business using these metrics. Price to free cash flow below 23 times, return on capital employed over 15%, that's a metric that I've been looking at a lot recently. Earnings per share growth of between 8 to 10%, dividend growth over 10%, free cash flow yield between 4 and 6%, which is about where the S&P 500 is trading at right now. Free cash flow to debt ratio above 20%, revenue growth between 5 and 10%, return on equity above 15%, and free cash flow conversion ratio above 60%. These are very specific numbers and very specific metrics, which is not a bad thing whatsoever when you're looking for winning stocks. At the same time, I am a little curious, where do you get these specific numbers from? Do you, mathematically do equations or whatever? I'm very curious to hear that. I'm sure I'll be in the comment section answering. But I think these are very solid metrics, and at the same time, I don't want to be too picky with our companies. I think it's a good thing to be picky, but definitely there are a lot of specifics here. So I'm wondering how much leeway there is really when you're looking at these. If there's some companies that may be missing one of these metrics, what's kind of the equalizer for you? Curious to hear. Before we get into all the holdings, let's get into the details of the portfolio. So since May 19th of 2022, so there's not a lot of long-term data here when it comes to the performance side of things, which there's nothing wrong with whatsoever. That's basically when he imported the portfolio into M1 here. He's up 42%, so that's very solid growth. That's outperforming the S&P 500 right now, which is about 16% since then. So it's very solid growth, but of course I don't like to look at short-term performance to really indicate how good a portfolio is. Anybody can be up in the 3 to 5 year category, but it's over a long period of time. I'm investing for 20, 30, 40 years. That's where I want to see the outperformance, but still nothing wrong whatsoever with his performance. It's been very solid recently. He has a dividend yield on the portfolio of 1.225%, so obviously dividend income is not a priority when it comes to this portfolio. He hit a bit of a lull with the market, but he's had a crazy run since then. He has 16 holdings in the portfolio right now, which I think is honestly the optimal amount. I have about 23 right now in the portfolio, and I'd like to trim down to about 20, but I think 16 is a really solid amount. Alright, so let's get all into the 16 holdings. To start off, we have Avgo, which makes up 15% of the portfolio, which is Broadcom. Broadcom, I think, is a very strong company. I think overall, it's a smart semiconductor play. I believe it's a very strong company, but the reason that I don't personally own any Broadcom right now is because of my circle of competence. I personally don't understand semiconductors whatsoever right now, so it's just not really an area that I'm touching at this point in my life and investing journey. But definitely don't count out me looking into Broadcom in the future. I think it's a very strong company, just looking at its financials. Next, we have Adobe, stock ticker ADBE, which makes up 11% of the portfolio. Adobe, I think I like it because it has a recurring revenue source and subscription kind of based business. Financially, they're strong, but obviously I've not done a whole lot of research into Adobe, and looking financially, it appears that they've had a few years of spiked up free cash flow and revenue and just crazy growth. So I'm kind of curious, how sustainable will that be? I'm sure he has an answer once again. I just don't know if I'd love it as a top 3, top 2 holding. I think it's a strong company for sure, but I just want to hear his thesis, conviction on it, because I think there are some other companies that I'll get into here that are better than them. Next, we have Microsoft, which I believe is the strongest company in the world at 9% of the portfolio. I love Microsoft so much as a company. Unfortunately, they have an AI bull run recently, causing the stock to climb up nearly to $400 per share, right now at about $370. Unfortunately, I was buying Microsoft in 240 and 230, so it appears that I won't be able to get those prices up near time soon. I definitely love Microsoft as a core holding in the portfolio. I'm also curious to see if he potentially trimmed any, as it's a pretty high valuation, especially if you're a medium or shorter term investor. But definitely right now, Microsoft is one of the highest quality companies in the world. It's crazy to think that I was investing in Microsoft before their AI segment of their business, but now to think that they have so much more growth potential with AI and to be really a leader in that industry, I think it's crazy. So, with Microsoft, I like that a lot. Next, we have Apple, which makes up 9% of the portfolio as well. Apple is an amazing business for sure. The only thing bad you can really say about Apple is really its dividend. Its dividend's been much more lackluster compared to their share repurchase program that they've had over the last 10 years, which has been absolutely absurd and quite frankly hasn't been done before by any company of this scale. Apple's a very strong business that produces so much free cash flow. They have an Apple ecosystem, which obviously you all know about, recurring revenue sources, and maybe a car on the way soon. But I love Apple a lot as a company, and I'm hoping as a long-term investor that dividend kind of gets picked up. But for sure right now, I'm loving my Apple returns. If Apple got to the 150s and 160s again, I'd probably start buying more. Apple's a top holding in my portfolio right now, but I haven't had the chance to buy any recently as it's been trading so high. Berkshire was buying a lot in the 150s. Next we have AGCO, which sells agricultural equipment. Now this is a business that I have to be quite honest and frank and transparent, I don't know anything about whatsoever. It's actually the first time that I've ever heard of it. With that said though, looking at their financials, it's really nothing to write home about right now, and they currently have a PE ratio of 7, so this could be more of a value play for him. But I'm sure he has his own thesis, as I mentioned. I'm not here to judge, so I do have a question mark on that position there. Next we have Walmart, stock ticker WMT, which makes up 6% of the portfolio. I don't like this really whatsoever. I think Walmart's an overpriced company. I think Target's the better option. I think Costco's a better option. And I just don't love it as 6% of the portfolio. So that's a position that I'm not a huge fan of at the moment. I think there are just better options out there. I just don't love Walmart also as a company itself when you look at it from a business perspective. It's just not really appealing from an investor perspective. Next he has Parker Hannifin Corporation, which I don't know much about. Lam Research Corporation making up 6% of the portfolio. Lam is a very strong company when it comes to the financial side of things, but I don't understand enough about the business for me personally to invest. Next he has Visa making up 5% of the portfolio. I feel like at least 2 times a month I'm making a video talking about Visa and how much I love them really as a business. In my opinion, I don't think there should be any reason for Walmart to be a higher weighting in the portfolio than a company like Visa. I think Visa is trading arguably fair price right now. I was loading up on it in the 230s and it's currently at 250. And I'm being a little more patient before I keep dumping money into it, but it's such a high quality company. Whether it be their crazy growing dividend, free cash flow, amazing share repurchase program, or price appreciation, there's so many positive things I could say about Visa as a company. It's truly a company that I can envision myself holding for the rest of my life. Next, he has TJX. I'll be completely honest, this is not my favorite holding in the world. I think the capital could be better allocated elsewhere, but looking quickly at the financials, I think it's a decent holding. Next, he has EOG Resources, which makes up 5% of the portfolio, which I don't know anything about. Then he has Brown & Brown Incorporated, which makes up 4% of the portfolio. Brown & Brown is an insurance company, which I like a lot, so I think that's a solid holding to have for sure. Insurance is a business that I want to research more in the new year and kind of understand more about before I invest, but it's definitely a sector that I'm looking to add to in 2024 and research more about. Next, he has UNH, which is the strongest and biggest healthcare company in the entire world, coming in at 3% of the portfolio. UNH is a compounder and a behemoth of a company. I think it should be a core holding in this portfolio. I just don't understand why you have a company like Walmart that has 2 times the portfolio value of UNH. UNH is not going anywhere unless the government says so. Next we have LMT, which is Lockheed Martin, which has ramped up recently with all the wars that are going on across the world. LMT is a strong business, but me personally, I'm just not investing. I never saw a good opportunity to enter, and I'm not really looking to add any new positions at this time. LMT, though, it definitely isn't going anywhere, and I think it's going to be a staple for your portfolio. And lastly, he has Dillard's and Microchip Technology is 3% of his portfolio, which I don't understand much about those to be making a fair comment on them. At the end of the day, I think the portfolio is solid. I'd like to see him up his stakes in Microsoft and Visa and probably sell out of Walmart for like a company like Costco. Overall though, I think the portfolio is pretty solid, but I definitely do think there is some fat to trim on the portfolio. Also, maybe looking at adding some real estate companies in here. I think that could do good for you. Thank you again for sending in your portfolio. If you want me to go over your portfolio in a video, join the Discord, link in the description, and message me from there. I want to thank you once again for making it to the end of the video. Check out the links in the description for any Black Friday / holiday sales going on right now. Thank you guys for watching, and do dividend stocks, not drugs. Have a good one.